There's a simple way to make large, consistent returns from stocks, even around a busy lifestyle. Most ignore it for flashier methods. In this video, I'll show you exactly what you're doing wrong and how to fix it. I'll break down the exact process I've used and refined over the last 15 years, starting as a retail investor just like you, to now running a hedge fund incorporated in Luxembourg. So let's dive in. Principle one is a mindset shift. Investing is not about quick wins. It's about staying true to the long-term principles of sound investing. It is about compounding gains. It's a proven message that has been buried in the chaos of the online world. But like a seed, we must keep the message coming through the rubble, and we must water it to turn it into a money tree. All careers and industries operate through best practices. Investing is no different. To give yourself any chance of making the kind of money you want from the stock market, you must simply do things properly. But most barely give this a thought. They give into the marketing, go straight to opening and funding a broker account, and straight to market. Huge mistake. We'll come back to why later. Let's get straight into principle two, discipline and emotional control. Most people fail not because of bad strategies, but because of what they do when things aren't going their way. Let me show you exactly what that looks like. Let's compare two investors. Both learn a proven strategy that has decades of success. We call this trend following. Investor one makes 60% in his first year and a 5% loss in his second year. Investor two makes a 5% loss in his first year and a 60% return in his second year. After 2 years, both are in exactly the same place, 55% in the green after 2 years. But who is more likely to give up or jump to another strategy? Investor two, because of that negative first year. I see it all the time. People give up way too early. Returns from the market are dictated by three things: market conditions, which we cannot control, we must only accept, and how good we are at making profit or protecting capital during those market conditions. Having the consistency and resilience to follow the system year after year after year, seeing it all the way through to the end. This is often where a lot of people fail, and without giving up your life. We will look at how to build a sustainable routine in principle 7. But before that, you need a system that works even when emotions run high. Principle 1 is the belief system. You need the right lens. Principle 2 is the behavior. You need discipline to act on it. I'm always reminded of the amazing quote in the movie The Founder, which is the story of McDonald's. A great movie if you haven't seen it, where Ray Kroc, the person who put McDonald's on the map, played by the wonderful Michael Keaton, is listening to a motivational speech called The Power of the Positive. And it goes like this.
Nothing in the world can take the place of persistence. Talent won't. Nothing is more common than unsuccessful men with talent. Genius won't. Unrewarded genius is practically a cliche. Education won't. The world is full of educated fools. Persistence and determination alone are all powerful.
Powerful, right? And very, very true. Okay, principle 3, understanding risk and drawdowns. There's a lot of unhealthy fear around the word risk in investing. Risk is instantly assumed to mean risky, losses, blown accounts. Yet we all seem to navigate and manage risk quite healthily in other aspects of life. Crossing a road to make sure we don't get hit, cooking food so we don't fall sick, looking straight ahead so that creep who makes the mistake of finding you attractive goes away. Yet we forget that when it comes to investing. Look, risk is to be controlled, not feared. Write that down, tape it to your screen, tattoo it if you must. Here's what I do. I don't risk more than 1% of my portfolio on any single investment. And my total portfolio drawdown never exceeds 20%. Why, I hear you ask? Good question. Because a 20% drawdown only needs a 25% gain to recover. But a 50% drawdown, that needs 100% gain just to get back to zero. I also build my portfolio gradually. Take a few positions, see how they play out, then add more. I don't hit 20% risk allocation in a single day. This way I have skin in the game and position to make some serious coin, but my hard-earned money is well protected. Okay, stick with me because in the next section, I'm going to expose one of the biggest lies you've been sold by finfluencers. Principle 4, stock selection criteria. I hear the same trite from finfluencers and city boys all the time. Stock picking is impossible. People should stick their money in an index fund or an ETF. Two things here. First, they are confessing their own shortcomings. Second, never let anyone tell you what you can and can't do. Stock picking is both a skill and an art. It can be learnt, mastered, and your portfolio can become worthy of a place in any art museum. You are the artist, celebrated. Where people go wrong when stock picking is just picking the wrong stocks. They fall into the narrative of buy low, sell high. Value investing, right? A flashy name. Think about it for a second. You are buying a stock which is dropping in price. It's going in the complete opposite direction you want it to, and you're hoping for it to recover. Stocks like this can take years before they get back to break even. A lot of time and money wasted. It's called catching a falling knife for a reason. But here's what no one seems to grasp or understand. Our philosophy is actually the complete opposite. We buy high, sell higher. Think about it. The stock is already moving up and in our favor. We just need to find the right entry, manage our risk, and ride the whole move up, and then exit when the reversal comes in. We'll dive how to manage the exit in Principle 6, which you don't want to miss. Ultimately, the exit is far more important than the entry. This is all part and parcel of what we call trend following, and is an approach that has topped performance tables since the dawn of the financial markets. Still unsure? Let's look at how this works in real world terms next. Principle 5, tools and systems that work. This next part is where most people try to overcomplicate things, but simplicity beats complexity every single time. Now, first of all, learn to be a good kisser. What do I mean? Keep it simple, sweetheart. A good investor is a good kisser. Your partner will love this in the bedroom and in the bank account. This is my process in a nutshell. I use a professional grade scanner to shortlist stocks that are outperforming the market based on a strict criteria. This means moving up quicker and faster than the S&P 500. Take Warren Buffett's Berkshire Hathaway, for example. It has climbed 235% since COVID-19. The S&P 500 in comparison has only climbed 160%. I use clean charts to analyze the results of the scan. I use only the essential tools, trend lines, support and resistance levels, the 200 and the 50 simple moving averages, and a very underrated tool, Donchian channels. You know the strict criteria I mentioned earlier? You know how you have a checklist system when buying a car or deciding if a person is a creep or not? Do the same for stocks. I apply a straightforward checklist system to every stock I buy. If the checklist system is met, I add it to my watch list or I add it to my portfolio. If not, I dismiss it. Simple, no second guessing. Now here's a pro tip and a key element of my criteria. If a stock has a history of consistently moving up, well, then it's very likely to repeat that in the future. See, the nuggets keep coming. Good investing isn't about guessing or reinventing the wheel. It's about following a proven system. And we've done all the hard work for our community members. So you can just plug in and go. Okay, Principle 6, abide by 2 proven mantras. You know how they say you are what you eat is a proven mantra? Put that third chocolate down. If there's one thing that'll save your account from destruction is applying the 2 following proven mantras. The first is cut your losers short, let your winners run. And the second, the trend is your friend until the bend at the end. These are well-known mantras, but often not very well executed on. So far, we've already looked at risk management and how we don't risk more than 1% per position. We already covered how to manage overall portfolio risk. Now, let's talk about how to protect and grow individual positions once you're in them. We also have exit management in play on every single position. We have a well-placed stop loss, and by well-placed, I mean wide. Wide so as not to get stop hunted. Day traders who complain about always being stopped out, well, use that gray matter. Use a wider stop loss. Take accountability for bad decisions. Your ancestors are watching. The time of reckoning will come one day, and use that same wide stop loss to trail your winning positions. This next part is a game changer, so stay with me. Do not set take profit levels. Instead, turn those target levels into compound levels where you buy more of a winning position. Let's look at this example. Imagine a stock starts at $100 and climbs to $200. You decide to take a 1% profit every time the stock moves $10 in your favor. By the time the stock hits $200, you've taken profit 10 times. That's 10% total profit. Not bad, right? Now, imagine a different approach, one you may not have fully considered. Instead of cashing out every $10, you add a new 1% risk position at each $10 increment, while keeping all previous positions open. So at $110, you add another 1%. At $120, another 1%, all the way to $200. Now your gains compound. By the time the stock hits $200, your total return is 55%, not just 10%. And here's the thing, to protect your gains, you trail your stop loss $10 behind the price. So if the stock eventually reaches $210, but then pulls back, you're stopped out at $200, locking in that full 55% gain. This is the power of letting winners run, compounding, and managing with a trailing stop loss. Let this sink in, because it separates investors who make money from those who just talk about it. I did tell you I would put you in a position to question all the nonsense and misinformation online. Influencers are absolutely clueless. Not you, not now. Okay, let's move into principle 7, execution and routine. At the very beginning, I said I will show you how to build an investment routine into your lifestyle so you can continue to live and enjoy your life, but have very smart processes compounding your money away in the background that require minutes of your day to manage. So let's break this down. Here's how to build that routine that keeps making you money even when you're not thinking about it. Start at the weekend. The markets are closed. You have 2 whole days to yourself to scan the market, do your analysis, build your watch list of opportunities, and manage your portfolio. Once you know what you are doing, you will have this down in an hour or 2. I like to do this Saturday morning, so I have it done and out of the way, and I can enjoy the rest of my weekend. Now, here's the smart thing. Because you have done this weekend prep, Monday to Friday will take you minutes a day to add new positions into your portfolio and manage existing positions after the market has closed for the day. This is the beauty of our trend following strategy. It doesn't consume your life. One deep review on the weekend and then minutes a day during the week. You can manage your entire portfolio. Scan the market, adjust stops, and identify setups. That's it. The market rewards preparation, and very, very handsomely. And don't underestimate the confidence and peace of mind that comes from knowing exactly what you're doing while everyone else, well, panics. Okay, principle 8, avoid news and noise at all costs. Be aware of what is happening in the world so you can have a meaningful conversation with your opinionated cousin around a dinner table. However, disconnect from all of that when it comes to managing your portfolio. I look at it like this. Wall Street is disconnected from the high street or main street, however you may refer to it in your part of the world. The stock market can and will rally despite what you see and hear in our media channels. Turn off the news. Seriously, influencers and the media thrive on fear. Market crash, recession incoming, world ending. It's what gets clicks. But what do the charts say? When you follow price, not headlines, you stay level-headed. You'll see opportunities others miss and stay calm while the crowd panics. Be greedy when others are fearful, but only if your system confirms it. Okay, so look, we've covered what you need, how to do it, and the mindset shifts you need to achieve success. But there's still one trap that kills more portfolios than anything else. And it's not what you think. Principle 9, what to avoid to stay on the path of success. This one's short. Day trading, because it does not work. Overtrading will kill your capital. Influencer hype and opinions, yours included, are one of the biggest threats to long-term success. Ignore them. The truth is in the chart. And make sure you avoid naysayers, those who failed because of their own poor decisions, given up and are now projecting their failures onto everyone else. Never let someone else's failure become the reason you walk away from your success. Which takes us nicely onto principle 10, support systems. The last one might be the most important, and it's something no strategy or chart can replace. Investing is lonely unless you have a tribe, and the right tribe. There was absolutely nothing like the kind of community I needed when we first started out. So between me and my co-founder, we created one. Let me share something quite profound with you. I remember early in my journey seeing a post in a trading Facebook group. The author of the post said, "I'm happy to lose money if we're all losing money." The engagement on this post was through the roof. It was unbelievable what I was reading. Now, this has always stuck with me, and it reminded me of everything I didn't want myself and my journey to be. That was just not me. So I created a community of people like me. Our private community is filled with professionals, business owners, and long-term investors who are on the same journey. We support each other, share setups, face challenges together, win together. This kind of environment is absolutely priceless. Success in the stock market doesn't come from luck, hype, or hustle. It comes from a proven process, from mastering your mindset to selecting the right stocks, controlling risk, and building a repeatable routine. This is how professionals play the game and win. This is how you take control of your portfolio, compound your wealth, and do it all without sacrificing your lifestyle. Knowing this, of course, is only half the battle. To actually do it correctly and to make those consistent double-digit annual returns, watch the next video where I walk you through the exact weekly process I use to find profitable stocks that grow my account by an average of over 30% per year.